Good morning, Accounting 201 students. Today, we're going to be talking about Chapter 10, Long-Term Assets, Fixed and Intangible. So starting things off, we need to differentiate or really highlight what a fixed asset is. All right. And so generally, when we're referring to fixed assets, we're talking about assets that are long-term in nature, that they are tangible, which means you can touch them, that they are used in the business and are not held for resale. All right. And so with that definition, really what we're trying to do is we're trying to differentiate a fixed asset from other assets. All right. And so that first component, that you can touch it, right? What we're trying to do is we're trying to say, hey, this asset is not an intangible asset, which we're going to discuss later on in the chapter. All right. And so it's something that you can touch. And so the three categories of the fixed asset are land, buildings, and equipment. All right. And so in this chapter, what we're going to do is we're going to talk about how you purchase a fixed asset, how you use a fixed asset, and then ultimately you dispose of the fixed asset. Then the rest of the chapter, we're going to be talking about intangible assets and also natural resources. All right. And so if you're following along in your textbook, we are actually on page 498. Right? And there's a really good decision tree trying to identify what a fixed asset is. Again, for the most part, a fixed asset, land, buildings, and equipment. All right. But it goes through the process. So we differentiated something that's tangible versus intangible, used in the business. All right. And so there are these things called investments. All right? An investment, a great example of an investment would be you see a piece of property on Lake Michigan, and you're like, man, this land is a really good investment. It's a cheap price, and I expect that the value of that land is going to go up. Right? And so you just purchased that land. Well, that's an investment because you're not using it in your business. So let me give you an example of what utilizing land for your business would be. So you see that same piece of property or land right next to Lake Michigan, and you buy that land not because you're planning on reselling it in the future, but you're planning on building your factory there. Right? And so we're going to purchase that land. All right. And so that differentiates between an investment and a fixed asset. A fixed asset you're using in your business. Then the last thing is trying to differentiate between a fixed asset that we're using in our business versus inventory. All right. And so let me give you an example of a piece of equipment. All right. For a farmer, if he buys a John Deere tractor and he uses it on his farm, well, that would be a fixed asset. Where if he purchased, where he purchased it, the John Deere dealership, they have that exact same tractor. The difference is they are not using that tractor, right, on a farm. They're holding that tractor for an inventory item. Their hope is to resell that tractor. So it could be the exact same tractor, but because the farmer is using the tractor and the dealership is selling that tractor, that differentiates between a fixed asset, the farmers, right, versus the dealership that is holding that for inventory. All right. And so what I'm going to do is I'm going to take my video down and share with you a Word document so that we can take some notes. All right. And so I'm going to turn off my video and I'm going to get my pad down and I'm going to go ahead and share with you. Oops. A Word document so that I can work through some problems. So as I said before, the first thing that we're going to do in this chapter is we're going to learn how to purchase. All right. And so, the journal entry for this is really easy. All right. So let's say that we're going to purchase some land. Right? So land is a fixed asset because we're going to put a building on it. So we're using it in the business. You can touch land, and we're not holding that for resale like an investment of some sort. And so we're going to record land. So we're going to debit that because it's an asset. Okay. Normal balance of an asset is debit. And we're going to credit however we paid for it. All right, so I'm just going to make it easy, and let's just say that we paid for this in cash. All right. And so the beginning of this chapter really deals with, well, how, all right, or what number are we going to use, all right, in the recording of the land. And so in this point, you need to understand what's the cost method or the cost concept. The cost concept basically says we're going to record that land for whatever we paid for. All right. And so we actually talked about this concept way back in, I think it was chapter 2, all right, the cost concept. We record assets for what we paid for. And so in the purchase of land, and again, there is a list on page 490, but I just wanted to address page 490, okay, some of the things that are going to go into land. So it's obvious, okay, that if you're buying this land, okay, whatever that purchase price, okay, and generally with purchase of land, you're going to have to pay, either some taxes or you're going to have to pay some commission fees to the realtor. All right, basically everything that it takes to get that land into its intended use. All right, and so this is kind of a tricky area. So let's say that we purchase somebody's farm, okay, and we're planning on building our factory on that farm. And so when we purchased the farm, it actually had an old farmhouse on it, maybe some barns or something like that. And so when we purchased the land, that's, we're going to record it for, the debit, okay? And so what is coming in here is obviously the purchase price of that land, okay? But we've got this old farmhouse there that we don't want, all right? And that we plan just knocking that thing down. Well, the cost of knocking that old farmhouse down is actually not going to be some sort of an expense. We're going to record that as part of the land. And again, the reason being is that we're trying to get our land into its intended use. All right, now it's kind of weird because the term for knocking a building down or destroying a building is what's referred to as razing, which I always thought that was weird. Okay, you think with razing, you're raising or building up something, but no. When we raise a building, we're tearing that down. And so whatever the cost to tear that building, all right, would be included in the land. Let's also say that, hey, this land was really kind of hilly, all right? And so we had to, before we could build our building there, we had to level that out. Well, the cost of leveling that out is actually not part of the building. The leveling would actually be included in the cost of the land. Because again, the cost concept, all right, is basically saying, hey, whatever it takes to get it into its intended use, we're going to record that as part of the purchase price. Right? And so leveling the land would actually be part of the cost of land and not part of the cost of the building. So again, the cost concept, whatever it takes to get it into its intended use. The next fixed asset that we would purchase would maybe be the building. And again, we're just going to buy this or build this building, and we're just going to use cash, right, just to make it easy. And again, the question is, right, what is included in the cost of the building? And again, the answer goes back to the cost concept. Whatever it takes to get it into its intended use. And so a building, all right, we could either buy an existing building or we could build our building. So sticking to my example where we bought the old farm, all right, we've knocked down the old building, we made space to build our factory. We also flattened or leveled the land, all right? And again, that would be the cost of the land. But now we're going to start building it, all right? And so whatever permits we had to get, whatever the cost to build that building, you know, the architectural plans, right? Whatever it takes to get that building into its intended use. Now, again, if we just purchase a building, okay, you know, it'd be the purchase price of that building, whatever kind of taxes, right? And then also the cost to convert the existing building into whatever building style or requirements that we need. Again, whatever it takes to get it into its intended use. Excuse me. And then finally, okay, the equipment. Okay. Equipment, all right, again, we're just going to buy this with cash. All right. And the question is what goes into the cost of the equipment? And so again, with machinery and equipment, you know, whatever the sales price was, the taxes, you know, freight to get it to us, the installation, you know, any kind of repairs, if we bought a used piece of equipment, you know, assembling, if we actually had to pay our students, or not our students, our employees to assemble that, right? Again, those would all be costs that would be included in the equipment. Right? And so, as you'll see in our next section, the cost of the building and the equipment are really important, because when we go to use these assets, right, we're going to actually end up depreciating those two assets. Because again, this goes back to chapter 3, right, when we talked about depreciation. And we record depreciation because we are using that piece of equipment. Right? And so I'm going to end it here, and we'll break this into you know, shorter sections so that we can you know, it'd be easier for you guys to you know, watch. Instead of watching one 2-hour lecture, I'll break this into smaller